And we are officially live, gentlemen. Hey, what's up, everybody? Welcome to the Weekly Jargon. I'm Abel Perez.
Jose Rodriguez.
And Rohi Zachariah.
And we are here jargoning about. It's been a couple weeks, gentlemen. Took some time off, collect our thoughts. Jose went to a Toastmasters seminar so he can learn how to calibrate and speak. No, I'm just kidding. But here we are. So how things been, fellas?
So far, so good. Just trying to make it day by day, but it's great to be back.
Yeah.
I'm ready.
Yeah. Rohi's ready. Jose sounds like day to day.
Yeah,
just trying to make it sort of thing.
He's heard from his Rivian stock this morning.
Yeah. Well, talking about stocks and making it day to day, all of those things, it leads us to a very important subject that is near and dear to every single person in the country, right? Which is our economy. And so, Jose, give us a little breakdown what we can expect to talk about today.
Well, we're going to talk about the possibility of home ownership. I think folks have found it tough nowadays with inflation being high. Are they able to buy a home? And if so, what does it take? Some of the questions that buyers will ask themselves right before they go and make that purchase. And what's taking place in our economy today that's keeping folks on the wall and keeping them from buying that home. But these are the types of questions that I think it's important to answer because a lot of folks out there wonder if now is the time to buy. So when is the right time to buy? And those will be some of the questions I think that we'll answer. Rohi, what did you say?
Yeah, I mean, it's something to look at to say what to buy also. I mean, I think it's, most Americans maybe are shifting away from that home ownership mentality like we used to have, but it's also what to buy. And I think that's maybe where it gets some of these people. So I'm interested to see what you're going to say here.
There you go.
Well, certainly we have two people, Jose and myself, who are in the, essentially the real estate industry as mortgage finance experts. And so we get to see that day in, day out, and it is an interesting topic because, like Rohi alluded to, the American dream has traditionally been, you work hard, you acquire property, you live there for the rest of your life, and you grow your family, right? But do modern times create a different type of American dream, right? So we're going to dive all into that. Let us know your thoughts as we kind of go through this episode. We'd love to hear your feedback, really trying to ensure that our content is geared towards you, our audience, which is without you guys, we wouldn't be here. So really appreciate that. Like and subscribe, smash that bell so you're notified every time we drop some new content as well. So should we dive right in, or are we going to go to Jose's jar here?
Well, we can go to the topics today, right before we get to the main topic. I think it's been tradition now for the last couple of sessions that we go in there and just to kind of calibrate where we're at. Right? So let's get one of these table topics here, and we'll start off with that.
All right, let's do it. So Jose's going to draw.
I'll get the first one here. For what reasons would you block someone on your social media, Abel?
I think we answered that one.
Did we?
Yeah,
okay.
that's a repeat.
You got to come right.
Okay, there it is. All right, awesome. Sorry about that, fellas. Okay, here's one. Have you ever been so embarrassed by someone that you pretended not to know them?
Wow.
If I have to answer that, it's probably someone in my family. I think that they were maybe it was something they were wearing or something. I go, oh my God, what are you doing? That's not my family. I guess when I was a kid, you try to be more mainstream, but if something didn't quite fit there, then you just wanted to, hey, I don't belong to that. You know what I mean? But that would probably be my
Yeah, I would agree. When you're young, teenager, kid, especially, you do tend to get really embarrassed about every little thing, And you talk about family members. We all have those, crazy cousins or something that, they're loud and they're themselves, right? But I think as you grow older, or as I've grown older, I've learned to appreciate those individual characters. And I think for the most part, everybody does, right? And as an adult, you don't really, if you're hanging with somebody and they're just firing off and getting crazy, they might be embarrassing you, but certainly not a reflection on you. And so I think we can decipher through that a little bit better. But so I don't get embarrassed by anybody anymore.
I know it's always going to be my dad. At least my dad of like the 20 years ago. You'd go to the restaurant, and if it wasn't right, He had to talk to the manager. My mom and I just knew it's
Oh,
time,
there-
it's time to get out of here. We'd walk out because we knew it was going to be ugly. We didn't want to be, we wanted this guy. So.
It's funny you say that. My kid said about me.
Yeah.
When I go and I ask for a coffee and it's just not right,
Mm.
my kids know, oh, here goes dad. No, I'm sure they probably say the same about me.
Yeah.
You want to grab one from there,
Yeah,
buddy?
let's keep it rolling. I'll let Rohi
Yeah, gotcha.
grab me one since I have short arms here. Would you return to your favorite hotel if you found out they only wash the bedspreads twice a year? Well, that's pretty easy. The answer would be no, right? I mean, we're not talking about, I don't know. Yeah.
But do you know?
But yeah, and bedspreads. Because
Right.
Well, it says if you found out. It says if you found out. So
Okay,
in
be
this
fine.
scenario, you know. The answer would be no. It wouldn't be my favorite hotel. I don't like being itchy, and that sounds like it would make me itchy.
I don't know. I mean, I think common practice, they don't actually wash them that much. So I think I just forget about it and just ignore it altogether anyways and keep going back. So
If it was my favorite hotel label, it'd be hard for me to say, damn it, because there's so many other there's so much more amenities to it,
but
right?
are they
that-
better? See, maybe
Yeah.
they're washing twice
Yeah.
a year also.
True that. There could be the poolside, the spa, everything else that you like with the hotel. So, I mean, the best.
Sleep on the floor,
Yeah. So the spreadsheets probably wouldn't make a big deal, but it'd be a tough one.
You guys are nasty. Let's go on a road.
All right. Last one here.
Would you rather have a friend who never reveals anything personal or one who tells too much?
I think, jeez, I think go ahead.
No,
Rory.
no, it's fine.
I'm
It's
jumping
okay.
in. I'm
It's
jumping
okay.
in. But I think I'd rather have a friend that tells too much. I mean, that would signify that, they really need somebody to talk to, right? They're, we all go through a whole lot, and I think the majority of us are kind of trained to, hold things in a little bit. But if there's a friend who's just out there telling me all their stuff all the time, they probably need somebody to talk to. And if I do have friends where they're like, they don't ever open up about anything, and typically those friendships are usually they never heighten, right? They never strengthen, and they kind of just stay stagnant, more of a kind of an associate versus a true friend. So
I'd have to agree with that because a lot of times friendship is based on trust. So if they're not willing to open up, then it's really hard for you to gain that trust. If someone concealing something or very reserved, then it's very hard to get to that person and try to create a friendship there. So I certainly would agree.
I think a lot of that is it gives your life a sense of normality too. So a lot of times they may complain about, you go like, hey, I'm kind of having the same problems, instead of feeling like, I just have these problems. They have the perfect life because they're
Right.
the kind of people you hang around. So
because that's all they post on Instagram.
yeah,
right?
exactly. I think it makes you feel like, hey, we're sharing the same things. It's a normal
Yeah,
thing.
it's when you find out that you're human.
Yeah,
Right, there you go.
Yeah, really, yeah.
Right. Cool.
Well,
Well,
right, man.
we're ready to go. Like, as a friendly reminder, we would like you to like and subscribe. Today, we're going to be talking about the economy, how it's affecting home ownership, and when the right time to buy, what decisions you should make in today's market. We're going to open it up with real estate mortgage guru Jose
Oh,
Rodriguez.
thank you. Well, I appreciate the title. I don't know about guru, but certainly been in the real
How
estate
long have you been
industry.
doing it? How long?
Well, I started back in 2001, so it's been well over 22 years now, and going. And when I see young professionals coming into the field, Abel, one of them, you see how much things have changed since I started, right? But a lot of the similar practices, right? We're doing the same thing. We're originating. Now it's been more regulated, but back when I started, rates were high, and people probably don't know this, but when I started, I remember rates being at 7.25, and I thought that was the norm. I didn't know too much about interest rates, so when I came into the business, I knew that 7.25 was the going rate. I didn't know anything prior to that, and I wasn't part of the generation that experienced the high interest rates during the 1980s. But certainly when I came in, that rate was the going rate. And homes around Madera, because I started here in Madera, were probably between 130 to 175 on the high end. And that was the normal price, right? For me, I thought that was a lot of money. What's happened since? Well, your average price today is probably somewhere between 350 and on the higher end, maybe 450. I'm not sure if you would agree with that or not, Abel, but homes around here, especially in Madera, maybe west side of Madera, may be a bit more. But that's kind of what I'm looking at. So there's been a shift certainly in price. And the question that I asked myself, has that price also stayed consistent with the price of the cost of living or the wages for that matter. Obviously, we've seen a wage increase here in California, but has that really made it possible for you to purchase a home? I know that back in the early 50s and 60s, you can buy a home with your annual salary. Today, it seems like your annual salary is you multiply that by 7, and that's the price that the average purchase price around here. So if you're making on average $60,000, then you multiply that by 7, and that's kind of where the price is, 7 to 6 times your annual salary. So that's kind of scary for me. Don't know if that's just the progression of the way the market goes, but it's something to look at, and that's why I think with inflation now, the way things are, people are starting to get on the wall. We obviously try to find opportunities, and Abel can speak on this, to help people get off the wall, because when everybody's on the wall, there's opportunities out there. And this is a time where people may say, well, shoot, not only am I getting a price reduction, but I'm also getting incentives to jump in there. And if you were thinking of jumping in and you're waiting for saving money or for a price reduction, well, guess what? They've given you that motivation to do that. And a lot of, I say a good portion of folks are jumping on that haven't already had their home. So that's what I can just...
What's the difference? I mean, I know we can pull up those financial calculators, but the difference that you're saying at 7% at 100,000 versus the 7% at this 400,000. What's a home payment look like though? What's that difference?
Yeah, so the difference in interest, and I was actually thinking of that exact same thing. You have the teeter-totter, right? So home prices at 200,000 with a 7% interest rate, that's $14,000 in interest a year, right? Houses have doubled, so that same $400,000 house at now, let's say a 4% interest rate, a little bit 3 points lower, but you're still paying $16,000 in interest on an annual basis. So that right there kills you. And how does that break down monthly? Well, you would take that 14 or 16,000 divided by 12, and then that's what's added to your mortgage. And so, in addition to that, everything else is heightened, right? So now your homeowner's insurance, the amount of principal that you have because you have that increased loan amount. And that's really where the biggest thing is. And 3.5%, that's an FHA loan, most popular loan out there because they're first time home buyer friendly, and they have some of the least resistance as far as qualifying standards. But 3.5% of $200,000, again, what's that? $7,000. And at $400,000, that's what, almost 14,000. There, he's the math guru right there. So you have to take that in consideration. Everything's almost nearly doubled. And to Jose's point, it's like, have the wage increases been enough to overcome that, right? So can you be a minimum wage earner and have home ownership in today's world? Probably not, right?
And that's becoming difficult.
Yeah.
That's kind of what we see in our field. Going back and looking at the 2005, this is the U.S. personal savings rate, right? This is how much people have in disposable income after all expenses are paid, and through certain through data that we've seen in 2005, that was record low of 2.1. So that meant that people were saving a lot less back in 2005, and shortly after, obviously you guys know history. The mortgage crisis, right? So in 2020, though, when the pandemic hit, people deferred on their mortgages, stimmies checks were coming in, and nobody was spending money because you couldn't go anywhere. So guess what happened? That personal savings rate went up to like 14%. As of 2022, that was 8.7. As of today, we're down to 5.1. So we're getting into that charter territory of record lows. We're not there yet, but it certainly tells you something that, hey, on average, people under the age of 35, on average, this is taking an average, they're probably saving about $3,200, and that's what they have in their personal savings. Whereas millennials, a little bit higher, but they're also on the lower end. And of course, your baby boomers being the higher end, somewhere in the range of, I don't know. Again, this is on a median. I can't use average because you have people that have millions of dollars and then people that have very little. So once you add the average, that's going to be a higher number. But the median that's in the middle is probably somewhere in the in the $6,000. So it's twice as much, right? And they have a little bit more money savings, but it's unfortunate because right now at this time, if $1,000 bill would present itself, 52% of Americans wouldn't be able to handle that debt. So when you talk about home ownership, you start looking at all these things, economic data, and then you start, can you afford a home? And of course, it's not everybody. It's you're taking the average of all Americans. In Madera, though, I think there's a big opportunity, and Abel can tell you, is because it's still somewhat affordable in comparison to these bigger metropolitan cities. People are somewhat, they're leaving those areas, coming to an area like Madera where it's more affordable. And of course, a $350,000, maybe a $400,000 home is a lot better than a $1.2 million home. So, I mean, that's kind of what I'm seeing. The data saying out there, the personal savings rate, I think this is what makes people that's what gets them on the wall. But the incentives that people are using, builders, for example, pushing out, hey, here's $10,000, $15,000, that certainly motivates people. And I've said this in several of my conversations before, is that this may be a good time. It's because it becomes a buyer's market somewhat, right? I mean, I'm not saying that it is now, but when nobody's buying and sellers are starting to reduce their prices and there's not competing awards for these homes, then you have an opportunity to go in there, slip in a good offer, get some rebates, and then boom, you may find something that you were looking for, that you've been on the fence for.
Yeah, I think so. I actually posted a video earlier this morning, recorded it yesterday, but it was about the difference between a cash buyer or a millionaire investor in real estate and the average person who's going to utilize mortgage financing, right? They're not the same, And I think with social media, we've talked about that in previous episodes. It's easy to connect or be connected with these gurus, real estate gurus, right? True real estate gurus, millionaires, and they're telling you, hold on, right? Wait till the bottom of the dip. You're going to be able to acquire properties. Foreclosures are going to start happening. Sales prices are going to come down. Auction opportunity, house auction opportunities are going to present themselves. You get homes at a reduced rate, right? But all of that advice is great for the guy with cash money. It's not for the average person who's needing to finance, right? And so if you are waiting it out, saying, you know what, I'm going to wait it out because all the experts are telling me to, well, guess what's going to happen when the floodgates open, essentially, right? The floodgates are going to open. You're going to be competing against these investors with cash money. Your offer is never going to get accepted against them because they just have more flexibility, less restrictions, more guarantee to the seller, more enticing. Not only are you going to go up against that, but you're going to go against your peers who are providing, who also have mortgage financing, who are also eager to buy a home, right? And so we saw that in the COVID era, 2001, 2022, where there was 30 or 40 offers on every single property. There was lines around the corners of new construction homes just to go see properties, just to sign up and say, yes, I want to buy it, right? That's the type of urgency we saw when rates came down, right? People said, oh, I want to jump in there now, right? Now there's a little bit of hesitation because rates are a little bit higher than what they were during that time, or what we're used to seeing in recent years. Not 2021 or 2001 when Jose first started, but in these within the last 10 years, rates are relatively higher. So that has created a little bit of resistance. But to Jose's point, it is a buyer's market. There are sellers who are willing to lower their price points now. They're willing to give closing costs. They're willing to pay for your rate buy down. They're willing to do the upgrades. They're willing to do the repairs. Things that we hadn't seen over the last couple of years, making it a buyer's market. So you hear the term marry the house, date the rate, right? And that concept is, let's secure the property today with today's pricing, because history tells us that this is probably as low as these homes are going to cost. They might dip slightly, but nonetheless, you lock in today, and you can always improve your terms down the road, right? And so there's a little bit of strategy that's in there, but certainly if you are somebody who's utilizing mortgage financing, your strategy shouldn't be the same as these cash money investors, because they just have a different opportunities. So
yeah, I mean, and having gone through that, it was 06 or 08 or whatever, I don't know the year, kind of went through it, but I mean, I was one of those that I would say came on board right before and went through it. And that's where I have hesitation is when I hear things like it's not going to go down. You know, I bought a house for 300. Everything was great. It was in a, you know, adjustable mortgage. It was good rates and everything. And then I watched my house go to 180. Couldn't refinance. Watched the rates go up. You're stuck with it. Nobody wanted to touch it for like 7 years. So that's where it's kind of hard looking at things and saying like, hey, it's the best it's going to get. Things can never get cheaper. That's not true. I mean, if people don't buy because, again, they don't have the money to buy, the houses are going to have to come down. How far they go down, it's how far of a crash it is. Is it as bad as we had? Is it worse? Is it just marginal? You know, that's where it's always is tough because, yeah, I mean, I love another property as an investment property. You know, I'd be kind of like in between some of those like cash buyers you guys are talking about. I don't have that kind of cash sitting around, but my income is good. I have, you know, the money and the means, but to buy now, no, it'd be crazy. 7%, you know, or 6%, whatever it is now, you know, at a house that is still feeling like it's overpriced. You know, what I see a lot, you know, and I can tell you why you're not having home buyers is because, like I think we talked about before, is majority of people now, kids are back with the parents, or the parents are back with the kids. Everybody's kind of bundling back up because of the cost of everything. Mm-hmm. I just don't see that, like, the market's taking advantage of those kind of people and saying, well, instead of just bundling up and staying into a rental, let's bundle the incomes and put you into a home. And, you know, as a family, like, help pay down this house, and then when things get situated, then, you know, spread out. I think that the family unit has kind of dissolved in America to where we're not working together anymore. It's kind of like, these are my kids, and they kick out, and they do whatever the heck they want, and I'm on my own, I do whatever I want, and we just struggle all together instead of kind of pulling together, you know?
Yeah, and I think the economy has kind of done that again, Rohi, because if you go out and you see the rental market isn't any cheaper than buying a home. So folks are typically pushed almost to buy a home because if you're at $2,500 a month, where your mortgage payment is $2,800 a month, it's not it's not a hard decision to make. If rents were a lot cheaper, then obviously something would be lopsided there, right? Then the housing market would have to make an adjustment. And I think we may see that over time because with increasing interest rates and increasing purchase prices, then obviously it reaches a point where people can no longer afford these, right? And again, probably back to certain folks with a lot of money. But if you're going to finance it, where you were financing at 3.5%, now you're having to finance to 7%. That's twice the mortgage payment.
And those people buying those are buying not because they're going to live in them; they're buying them to be a rental.
Yes, but look, even rentals.
If the rental doesn't make sense,
here's the thing. For example, you had a lot of these big investors like Blackstone. You had Redfin, Zillow buying up all these properties. And it's like a car lot. I'm just going to use a car lot, for example, right? You borrow money from a bank to buy the inventory. You leave it out there. But every day that car sits there in the floor room, it's costing you money. Mm-hmm. Well, that's no different when you're borrowing cheap money to buy these homes. But then, you know, you start seeing that you're not turning those over. And if you're not turning those over, then you default on that loan, then this is where the floodgates also open. So a lot of these folks, Blackstone and or Zillow, Redfin, they've reported some losses in their because they were buying up every single home. Mm-hmm. And now that inflation's creeping up, they got to look at the capitalization rate of what they're making. So the investor's thinking, wait a minute, if the average cap rate that I was making on a rental was 4.5%, but yet the 1-year treasury is 5%, why would I want to invest in a home where I have to put a lot of money, a lot of effort, when I can get the 1-year treasury at a 5%? It's a no-brainer. You're going to back off because they've made it incentive for you to go out and invest in bonds, and it is investing in real estate.
But doesn't the homes come with all the incentives of the tax?
Well, there is, but but it depends on the person, right? If you're the individual buying the home, then yes, it does. There is an incentive there. But if it's the investor has to look out for that money, and that's huge. Mm-hmm. So right now, kind of to Abel's point is, you're pretty much on the fence about buying a home because you don't know if it's the right time or not. But again, you're the one financing. When they call me, they tell me, hey, how does it work to buy those foreclosures? Now, well, the bank foreclosed on a home, they put it back up for sale. And then you go out and you make an offer. Mm. Oh, no, not that. What do you mean? You mean you want to go buy it at the judicial foreclosure? Oh, you have to have cash. Oh, I don't have that. Okay, then because the term foreclosure for a lot of people, I think it's misconstrued. But foreclosures and judicial foreclosures, of course, that's for the investor that's going to buy that cash. They're starting a low bid here. You buy it, but you take everything with it. Anything that property has, liens and what have you. If you don't do your homework, you can lose your ass off there. Whereas the average consumer, they have to be protected because they're being financed. The bank is not going to want to buy a foreclosure for you because you want to buy a foreclosure. You have to go through the process. The bank takes over the property, forecloses on it, brings it back, and lists it with the real estate agent. Therefore, now you can buy this home that was foreclosed. Different than buying a judicial foreclosure.
But at that point, so can everybody else.
So can everybody else, exactly. And, and again, it comes down to where is that income? Because you still need down payment, right? And you have to qualify. So you need income and you need credit. So the way I look at it is you have to have credit, income, and assets to be able to qualify for this and make sure that you're an eligible borrower. And a lot of the times what I see is that, it's more of a two-income deal now. You're starting to see, and I see this a lot in millennials, because millennials is the group that's making a lot of these purchases. You still see some Gen X's, baby boomers out there, but most of them already have their homes. They're either sunsetting, paying off their home, but it's the millennials that are coming up. And I see that, there was a talk before that these millennials were not going to buy homes, that they were going to move in with parents. But frankly, it's been the opposite. They've actually driven the market here in the last couple of years because it's two incomes. They're starting to, they got good paying jobs, and they see that a $2,500 to $2,800 payment isn't as much as me as a Gen X. I don't want to pay more than $1,000. That's still my mentality because I know what happened in 2007. I was there, I lived it. And people that were in the generation of the Great Depression, they feel the same way. Any of these shock events that happen, I think they will resonate again once something like this comes again. But the millennials haven't had to experience that. So they're driving this market, and I see a lot of them just saying, you know what, I need a home. And they're making the money. So opportunities do come up. And kind of to Abel's point, whenever there's an opportunity there that you can get yourself into where you're not competing with everybody else, it's an opportunity. Take the plunge. Make the investment, fix your rate later, but secure your property. And yes, dips are going to happen. Dips are going to happen. In history, we've known that it's happened. But again, that price will come back up again. When my father-in-law purchased his first home, it was funny when he said he bought it for $2,000 back in 1950. You tell me where you find a mortgage for a house for $2,000. My parents bought their mortgage, I think, when they purchased their home for like $60,000 to $70,000 back in the late 80s. I don't think we'll see those prices because of inflation, because of the cost of living. So I think everything will essentially slowly appreciate.
You can see those prices, but it won't make sense to a home, construction company. Or they're not going to go build a $100,000 home because it's going to be a 2,000 square foot house, on 2,000 square feet of property.
The model may change. So look here, if you look at Old Madera here, for example, you're going to see homes that are between 2,200 to 3,000 square feet. Think about it. Who needs that much space now? That type of construction isn't really happening unless you're living somewhere large. But now people are settling to something smaller, and anywhere between 1,000 square feet to maybe at the highest 1,500 square feet. There's still those 2,000 square feet homes, but people are settling. They're having less kids. They're both working, so it's all they need is a place to stay and call home. And I think you're starting to see that. So it's the developers catering to what the environment's saying. And right now, if they're saying, hey, I want the smaller home because that's what I can afford. Less material, less cost, therefore I can deliver that product to you.
It seems like that answer is we're building in the wrong direction. The answer to that seems like we should be building multi-level like condos that are 1,500 or 1,000 square foot condos that, again, makes sense to build a 300 unit condo system or whatever you want to call it instead of spreading out again as wide as we can on single level homes.
Well, I think that obviously those exist in other areas, but I don't think that type of adjustments in demand here in Madera, California.
I mean, they're trying to build them, but we keep calling them low income housing, and they get rejected.
Yeah, so like Jose was making a point about people willing to kind of sacrifice the size of their house, and thanks to HGTV and everything, it's
Yeah.
like tiny homes and how to make the best use out of your place. And man, I see some people with 1,000 square foot homes, and they look really neat. They do them up really nice. But I think the kind of the culture here, especially in Madera, has always been backyard barbecues and things of that nature, right? Have the family over, even if it's a small home, don't worry, we're going to be outside. And that's where I think condos aren't as attractive. Multi-level condos aren't as attractive. At that point, I'd rather just get an apartment versus that condo. And I mean, they're there. They do get popular. But I wanted to circle back over to Rohi's point, I think, that he made earlier about families willing to kind of, consolidate a little bit, right? And I've seen that to the point where I think if there was one good thing that came out of COVID, it was the unity it brought a lot of families, right? And so you are seeing a lot more parents willing to co-sign for those millennials, right? I think people realize the value of home, the value of having your own space. We were cramped up and kept indoors for so long. People said, man, I want a place of my own, Mm-hmm. And so a lot more gifts, people being a lot more willing to gift their kids or their family money in order to purchase homes. Real estate has proven to be a safe investment, whether it's, for your foundation to building a family, whatever the case may be, or financially growing equity over a certain amount of time. And so I think I'm seeing that more with families. It's like, oh, you're buying a home? That's a very great thing. Here's a gift. Mm-hmm. Or yeah, go ahead and use me. Let me be on that loan, right? And I think that's pretty cool. And again, when you combine that with people kind of humbling themselves and saying, okay, I'm okay with that 1,200 square foot home. I'm okay with that fixer upper. I have a family to rally behind me and help me fix it up. That's where you're seeing this demand for housing, and bouncing off of demand for housing, we still have high demand. There's still a shortage of housing, specifically in California and the Central Valley, and builders are sitting back. They have the land, they know the plans, and they're just waiting for a combination of raw materials to decrease and that maybe rates to go down a little bit so they can open up floodgates. But they know that once that formula is correct or right where they want it, as soon as they list those homes, they're going to go pretty quick. There's people that want to buy, and so I think that's the biggest difference between now and 2028 is you have better lending practices. You have people who are actually qualified for, who actually are qualified in making enough income to buy these homes. You don't have stated income and all of those bad practices. And in addition to that, I think that's why we're looking at the jobs report so closely, right? Because we learned you can't have this housing bubble, bad lending practices, and then you just need people working. When people stop working, that's when things get really bad, right? So if we can keep people working, then demand for housing is not going to go away because people will be able to muster up and pay that payment.
Yeah, and then I'll go back to what to early pandemic and what happened with the stimulus, right? Obviously, we opened a floodgate of money, right? And it gave people access to cash, especially very cheap. So this is why those personal savings rates went up, because now not only did you refinance your home and pull out equity at a very cheap rate, you also had monthly checks coming in. You had other stimulus. You weren't spending. Mm-hmm. You weren't out there traveling because COVID didn't allow you to do that. But now all that money out there means that there's a lot of money in circulation. So the feds have to control that. And why they're increasing the Fed rate is because they see if we don't do this, then prices can get out of control, and hence where we're at today. So I think there's some announcement or there's some talk about them. Not only did it come down to 25 basis points, that may just jump up again, and that creates some panic around the stock market. You saw it this morning. You said, hey, things are dipping. Again, people are making adjustments on their investment and hedging their risk. And I think with real estate, it's no different. Obviously, like you said, builders look for two things: signs of the price to build a home and affordability. If I don't have a demand up here, then I'm not going to build and leave out spec homes out there just sitting there, because, again, it costs me money to build that home. Unless I'm a super billionaire just wanting to leave homes out there, then I don't think any person with a sense of business practice is going to do that. They'll do it based catering to the demand that's out there. And just to touch on one other point, you mentioned something about the smaller home and why not townhomes. Well, it just caters to demographics. Mm-hmm. If you go back to the Great Depression that took place, those people were like shocked. And the way their mentality was moving forward was very different. Their kids, the offspring, which is your baby boomers, they had a whole different mentality growing up. And you saw this huge wave of baby boomers kind of become the leading money makers. Mm-hmm. And to this point, they hold a lot of the wealth. Now you got the Generation X, a little bit more conservative, right? And now we have the kids of the baby boomers, which are the millennials, and they're just taking off from the same thing that their parents had given them. Mm-hmm. They give them hope, an opportunity, and that's what kind of gives me hope as a Generation X. I'm probably a lot more, in my generation, we're probably more conservative than the millennials and or the baby boomers, but it gives me hope that underneath us is a foundation of people that actually will want to push us up. Because other than that, then we're going to be facing issues with Social Security, Medicare. But because of them, I want to say thank you. I really want to say thank you here publicly.
You're welcome.
No, I mean, my point was to say that my first house that I got wasn't the one I intended to live in forever. It was something I could afford on my income at the time, and that's where to some degree I disagree with the Marriott kind of thing. I think that somebody who's a first-time home buyer shouldn't be sold on the fact that you buy this because we're going to live and die. You buy the first one, which is the one you can get into. It's a little bit more affordable, and then after a couple of years, whether it be 5, whatever, 10 years, you say, okay, hey, my life has gotten better. I got a better job, as it things should. Your house has gained value. You sell it and you move to a nicer one, and that's how I was raised, is that progression of you kind of keep going instead of saying, well, you know what, skip the middleman, buy the one now that you want for the rest of your life. It's borderline on your expenses. You might be okay, and then to have that $1,000 payment come in because your car got broken down or something, and I can't make the house payment. Now you lose it. Now it's foreclosed, and I'll be the one buying it for cash for half the price you paid now.
But what would be the option right now, especially in today's environment?
That's what I'm saying. I know that's to me, that's where it gets frustrating, is there is no home for $100,000.
Yeah.
There is no option for that person to say, let me just buy something.
Well, let me ask you, Rohi, if there were homes for $100,000, how many would you buy and take off the market? And that's kind of the problem, right? We do have those people with cash money, let's say $300,000-$400,000 who are willing to take 3 or 4 of them off the market. They don't need to live there.
But that's what I'm saying.
They're buying them now. They're renting them out, and they keep it away from those who actually need to be able to afford
those. That developer, if you just said, okay, you've got 100 people that are willing to spend $100,000 on a home, go buy and make these giant townhouses that multi-story and pile people in and get it done.
and that's
fine. That's what you're going to afford for $100,000, right?
I think the townhome caters to a certain demographic. If I'm thinking townhome, I'm thinking, okay, maybe it's a couple, probably empty nesters that want to go out, or maybe young millennials, and I keep on saying young millennials.
Get over it.
But I'm not picking on millennials or nothing. I'm actually saying that's a good thing. Mm-hmm. But it's just a young couple that wants to get their first starter home, right? Mm-hmm. But if you have kids, think about it. On average, 2 to 3 kids. Townhomes are probably they're not adequate. So that's why these communities now, you start seeing how environment or today's society has changed the way you're building. These folks are building communities that provide amenities for families to share communally. It's a community, right? That's what they call the word community. Yeah. Is that they share a community hall, community pool, community here, community.
Yeah, but you're just disguising it. You just described exactly what I said.
I get
Build
it.
a bunch of these homes with the shared amenities.
But if you look at if you look at a townhome, a lot of times the space isn't adequate enough, and that's what I'm trying to get at. So a lot of these other homes, you say 800 square feet. That's typically your average townhome. Mm-hmm. It's really small. I don't know that if you have 2 to 3 kids in there, if that would be adequate. No. At least in me. And yes, I do see that more families, because I do see it. Families are coming together, and they're having to buy these homes together because they're seeing that there's no other way of doing it. They have to combine 3 and sometimes 4 incomes. The majority that I see is 3 incomes. Two incomes is still making it. But before, Rohi, and I'll make an example here, and this will probably be my last comment, is that in 1970, and I said this before, a person working in a meatpacking place, working union jobs, making about $27,000 a year was enough to support him and his family. No problem. And they can still maintain. That same meat packer today is probably making the same amount of money, no longer union, but making $27,000 a year. And that may be off. I'm not saying that 27, but somewhere within that ballpark. And affordability has become obsolete. So now you need to combine other incomes to be able to supplement the income to keep up with the cost of putting a home.
I'll jump in and I'll say before I disagree with Rohi, I'll agree with Rohi. I got to change my term. Marry the house, date the rate. I agree. You should only be married once, and it should be a lifetime, right? In today's modern society, divorce is kind of a thing, right?
Yeah.
But I do agree with that. You know, you buy your starter home, and you grow from there.
Yeah.
Thanks to equity, thanks to appreciation of homes, it gives you the ability to sell the home within 5 to 7 years, roll over $100,000 in equity, apply it to a bigger house, still be within the same ballpark of a monthly payment. I mean, that was my story, and I'm sure that's the same for each of you guys. So I do agree with that for sure. But with the disagreement, real quick, the disagreement is I don't see value in townhome complexes, $100,000. Anytime we're making a purchase, it's because we want to. It's an investment, right? And if you have those, who would want to invest in something like that? I mean, is there going to be resale value for that property? And if the answer is no. I know firsthand. I was recently, trying to sell my home, and I had, ambitions on doing other things. But the reality is, if nobody's buying it, your house is worth zero. It's all figurative numbers unless you got a buyer willing to pay for it, right? So if you have this project essentially, right, and each of these units, you paid $100,000, now you're trying to sell it for $150,000. Even if that sells, well, guess what? Now the neighbor's going to sell it for $160,000, $170,000, and in 20 years now you're back at a $300,000-$400,000 house, right? Best case scenario. Worst case scenario, those values depreciate because nobody wants to live there. They're only attracting people who want a $100,000 home or could afford a $100,000 home, and there is a correlation between people who who want to pay that for a cost of living and crime and all those other things, right? And so you could expect that project. I mean, look at the projects, right? Over in New York, you could expect that project to look a certain way and just kind of be engulfed by the things that will decrease the value of those properties.
Well, I'll tell you what, if you're looking and you're in the market for a home, feel free to reach out to myself or Abel. We both are pretty good, well-qualified experts in helping you with that. If you're looking to lease a home, then talk to the landlord here, Mr. Zachariah.
All right.
We just hope you enjoyed the show and at least get something out of it. Again, if you're on the fence about buying a home, it's good to get informed. Make sure you reach out to someone that can help you. Again, you have two qualified people here. Reach out to Abel or myself, and we'd love to help you out.
Yeah, absolutely. Well, again, knowledge is power. Everybody's situation is unique and different. So get an assessment on your situation. Let us know your game plan. We could evaluate that. All we could do is give you the numbers, right? Let you see that on paper, compare it side by side with other options that you may have, and you can make the best financial business decision for you and your family.
All right.
Anything you want to add?
No, I'm good.
Coming, Rat? Yeah.
All right. Well, gentlemen, thank you for another great week of the Weekly Jargon. Like and subscribe, and we'll see you guys next week.